Hello, here we are. My name is Roy Idrach, and I'm here to make a presentation, a facilitator for the city local library. This is lesson one, and we're going to start in a few minutes. We're going to have a little briefing about my life, what I had done, my experience in trading stock commodities throughout the years. Would like to let you know that I started back in 1972, and I have my shares of stories to share with you all, from losing money and making money and crazy stories. But for now, let's begin with a quickly brief from the local library and this year, because of the virus, the library canceled our yearly seminar about learning about the stock market and investing. And recently the library have requested that is we can make some videos with the same material and post it on YouTube. They're also planning to do the same thing on the library channel. So with that, let me start the presentation. This might take about an hour, and there's some videos involved and materials that you need to follow through if you want to be a good trader and an investor. So with that in mind, let me start over right here, and then we continue. So see you on the other side. Okay, here we are now. As I tell you before, I was mentioning, every year we provide this seminar free of charge in our city. Our local library and the county allow us to do that. The city also has given us the event center to provide the class on Friday and one on Tuesday at the library. You can tell it's from 9 o'clock in the morning to 11:45, and it's about 9 weeks involved into this. And of course, you don't call now the library since this was back in March, but as of now in October, you can write to us of Floresville 2018 at yahoo.com, and we will answer your questions on this video as soon as possible. So I'll be checking on them every day. So you have any questions, just send us an email to Floresville2018 at yahoo.com, and that will take care of it. So with that, today we're going to load this into my channel, and in the channel going to be a playlist, and the playlist going to be on the public library. So you go to a public library, you'll be able to see this video. So for now, this is your general idea of what the presentation is when we advertise for the class. And with that, let's move into our first graphic that involves the library. This is the presentation where the people that attended the class and three finals, the finals there with the director of the library, and the newspaper came in and give us a review of what we were doing. And since when I've been investing and doing this in 1972, and I started with $500, and now we handle more than that. That's 48 years ago, so of course. And the gentleman on the right is the one that won the prize of the class. With this, let me go over and tell you about my life when I was a kid. And this is me, was about 4 years old, and my mother's made this kind of sailor dress. This is go back to 1945, 44. This is during World War II. And most of you don't remember those things, but I remember I'm only 80 years old, so I can tell you quite a few stories. So anyway, we were very poor due to the family thing that happened. My father had lost his job and stuff like that. So we ended up living in a public housing project. I think that it was paying something like $3 a month for rent and things like that. But so we had come from a very humble family, and gradually we have progress and make it possible. I was born in Boston, Massachusetts. And here we go with the next slide. By the time I was 18, I ended up in the military. I volunteered to serve. Back then they had the draft, but I didn't wait for the draft. I went ahead and volunteered and ended up at Fort Sam Houston, Texas, where I got training as a medic. You can see over there the Red Cross. Later on, I got into other things. I got into being a pilot. So this is one of my love books. That was back then by 1967. So I was getting close to start. By 5 more years, I'd be probably doing the stock market. So from there, I had done in between the appliance business. We have about 10 stores in the state of Texas. That's me on the middle, just in case. And you can tell that this was back in the 70s. From there, I got into publishing. This was one of my first booklets that I published. And from there, for this publishing, we continued doing, instead of business, we start publishing newsletter. I started publishing newsletter about gaming, lottery, and so on. And then I caught up with other magazines, what I was doing. So then I went national, where they were featuring me on the magazine doing question and answers about gaming and lottery. So that's me now when I had more hair. Now I have very little. And so that's some of the stuff that got to my life. So of course, I will have continue working, investing in the lottery. So this is some of them for 1995. From there, I went into television, and I was doing television shows for Univision for a period of time. That was on Saturday night. They tell me there was over 300 countries that I saw that video. And of course, I was much younger, but by now we are back in 1999. And that was kind of a lot of fun, and good pay and plenty of stock market during the day. So every time I go to New York, there's always somebody from the local TV and national TV and television that we communicate with them, and I provide interviews about economics, how the markets are doing, what I think about the country, how America has changed in so long from the days of Luther King of what it is today. And from there on, I also go to the schools, and in the school I provide career days to teach the kids about investing, the opportunities of working in bank financing and the stock market. And hopefully they follow through. Over here, we're showing them one of the videos you're going to see later, how the stock exchange work, what the posts mean, what they do at the post, how the post get the money to do the transactions, and so on. There's another one for the military. We provide help to the Project Warrior for veterans. We donate time, help with the veterans also, and the Lions Club for children with in need of glasses, and so on. Here's another group where we gather with them and we talk about the life, my life when I was in the service. And with that, we move into what we're doing today. So today we're going to start with type of careers and payment and pay. How much does it pay? Before we start the class, to kind of give you an idea of what is involved and the opportunity that you have by learning what I'm going to teach you on this seminar. So over here, we're showing the different salaries pay. This is from 2010 and census. So we have, for example, the people that deal with DirecTV, Mr. Michael White, make about $15,000 an hour. They're very interesting because some of us don't even get not even $15 an hour. I started washing dishes for 35 cents, worked my way up, So we got over here the people from Walt Disney, the CEO at that time, making $13,000 an hour. And then we move into bankers and insurance, and people like JP Morgan, the CEO, make about $9,000 an hour. We look at Bancorp and Morgan Stanley, $7,000 an hour each or so. And then we got Goldman Sachs, Mr. Lloyd Blankenfield. He make about $6,000 an hour. However, in 2008, he also got $400 million in bonus for bankruptcy of the bank. Very interesting. And nobody went to jail. Over here, we got the top attorneys in the country, the 10 most earners, and they make anywhere from 19,000 to 5,000. Now here we go to the very important thing. This is the career people that choose the career of what I do, buying and selling stock. They are a much larger scale. They are hedge fund managers. So they get your money from your retirement account. They charge 1% on the billions of dollars that they manage. And this is the kind of salary they get. So you take Mr. John Paulson. I think at one time he was at the Treasury Department. The name sounds familiar. Mr. Paulson make $2,255,000 an hour. Poor guy, man. I bet you he got a hard time paying for coffee. Mr. Ray Dalio, a gentleman that we normally see on TV, he make about $1.5 million an hour. And we go so on. We find over here Carl Icahn, the corporate raider, $432,000 an hour. We got George Soros, that you see him sometime and mention him on TV and how he migrated into this country and all the money he had made and all the things that he run and how he controlled politicians, where he make about $216,000 an hour. With that, we're going to move to the other part. What do we play in society on this society? What part do we play on it? This guy that make this kind of money, millions of dollars an hour, they fall in the top 100 of 1%, and the average group per income. Then you get the 1/10 of 1%, half of 1%, and then the 1% that was 700 family, and you get at the top 5%, and then here 7 million family make about $127,000 a year. No an hour, but per year. All these guys per year, when you break it all down. And then we have a 90% of the working force in the United States at the census of 2008 that they make less or about $31,000 an hour. And this is where the discrepancy comes in. There's a large difference from people that make 100,000 and 90% of the family, working family, they make 31,000. Of course, there are going to be some that make 50 and 60,000 a year, but at this level, some of them get a lot of food stamp and government aid to survive. You don't want to be part of this section here, the 90%. For some reason, 90% of the residents, the citizen, the working family make less than everybody else. And it's kind of sad, but that's the way it is. And I want to change that. I want to teach people and learn so they can move up to the top 10% or top 5%, and that'd be much better for better life for them. Having that said, it's just a general idea that there's opportunity for you there. And as you know now, you can make it through the stock market. You can do it through investment. You participate in banking, financing, get a good education, and that's what we do, trying to get it. So from there, I'm going to give you a little background about my life. This is back in 1987 when I used to buy and sell stocks. Some of the records I found recently, so I shared them with you. So have the opportunity to see how it works. This is from the commodity account with Prudential Security. You can tell it was back on 12/31/1987, and the different stuff that I trade. I used to trade. I started with copper and had done gold, platinum, S&P, New York Index, Japanese yen, pork bellies, and so on. Not all the trades are profitable. As you can see, we got about $182,000 here in copper, but then we had $26,500 lost on the other side too. So there are going to be times that when you trade, all you need to do is get out early so you won't lose your money, and and then write down on notes what you did wrong. Can you have done better to avoid that? But like everything else, there's not a perfect system, and if you that's what you're expecting, then you're on the wrong trade. Or you want to keep on doing what you do now. You're an electrician, you're a painter, or you're a mechanic, and you cannot accept the fact that there might be some losses involved. Well, I recommend that you stay with that or remain in your retirement plan that you have at work, if you have any, or if you want to depend for Social Security. But I guarantee you that by the time you finish this course, you will have a different view of how the market works. And if you practice on paper first and do your trade on paper, you get good at it, and then you can change job just like I did, and they just work from home or from the library or for whatever is a laptop or from your iPhone as far as it's concerned, and you'll be able to make some good living and support your family and have fun with what you're doing. One thing about it, you need to like it. If you don't like it, then it don't gonna work. With that in mind, we want to move to the next slide. And this is really when your class part begin. This is a little deal that I tell all my students when they come to the seminar. Number one, stop tip of the day. The educated trader normally get paid from the trader who had no education, no plan, and trade on emotion. Trade on emotion can happen many ways. Can happen because you don't want to lose your money, so you stay a little bit longer. You're trading on emotion because your dad used to own the stock, so now you want to buy it and use it. You know, things like that. Oh, I'm going to buy the stock because my dad worked for Pepsi, so I'm going to buy Pepsi. I work at McDonald's, so I go to McDonald's. Well, that's not the way it works. Also, here I'm going to remind you that every time you buy a stock, there's somebody on the other side taking the opposite position. So money, when you lose money, money don't get lost. What happened with the money is that the money transfers from one to another, you know. So that's just the way the deal is, and we have to accept that, and we navigate through all the stuff all the time. I've been doing it for 48 years, and now I'm 80. So if I can do it at 80, you can do it too. If you were a mechanic, I used to be a mechanic. If you wash dishes, I used to wash dishes. I used to work in service station pumping gas. So this is not because education. Education is not the key. It's that you have to follow simple, very simple common sense idea. Any little common sense will can make you money. You don't have to have inside information or anything like that. It's just common sense. And from dishwasher to do what I do now, I got a good life. I've done very well. I've been doing it for 48 years, so there must be something about it. So always remember that I try to tell the kids US to work in banking and stuff like that, but some of us already, our age already passed to go to school and put 4 more years of college, especially me at 80, right? I can go for free, but it don't do me any good. So this is the next thing that we deal with it. What does it take to be a good investor? To be a good investor, the one thing that it takes first is the discipline. You have to have discipline. If you don't have discipline, you will have a problem because you don't going to be consistent. You're going to get bit disappointed. You know, many people ask me, well, how much money I need? Money is not the deal. I started with $500, okay, back in 1972. And a couple of times I was trying to give up. There was one morning that on the opening of the market, I was down $10,000 and I didn't know, I didn't even have $10,000. But I learned my lesson. By the end of the day, I was $10 ahead. So keep your calm. You have to be disciplined. The number two is you have to be a clairvoyant. In other words, you need to clear vision. You have problem with your children, so you have problems with your brother or family, don't trade. Don't do it because your mind is not set for it. You have to have a clear vision and also have a clear idea of how the market is working. So this is part of emotion thing that we don't practice, and then what happens is that this is how the majority, 90% of the investors lose 90% of their money in 90 days. That is called the 90-90-90 rule. 90% of the people that come into this business lose 90% of their money in 90 days. This is why the stockbroker keep on advertising on TV and on radio to get you back in to replace those accounts that then burn out. There's no money to trade, and then depend from the trade to make a living themselves. You have to be obsessed. You have to like this. You really have to be involved. You should be preoccupied when the market opens. Sometimes I'm going to trade in the morning, and I'm going to start at 8 o'clock in the morning. Market open in euros at 3 o'clock in the morning, and I wake up, set the alarm, or wake up and take a look at it, see what lay ahead. So when the market open at 9:30, what are you going to do? This is part of it. It comes with the business. A lot of people say, oh, well, you make this money, that's easy. Well, they don't know what is behind that, And you try to explain it and they don't believe it, or they say, no, I know this guy. I don't want to know what this other guy does, because what he does, it damages your thinking. Always remember that. Don't listen to anybody, because if you listen to somebody, they might influence your way of thinking, and it's going to cost you money. Number 4, you have to be fearless. This is from the Middle English, bold, brave, and intrepid person. If you're going to trade, and when you're going to buy the stock, you are worrying about it, you're going to lose the money. How about if I lose? If you're going to be thinking like that, don't even bother to trade. It's a waste of time. Because what you're really saying is, I'm going to give my money away. I knew I was going to lose. I'm going to lose it because I don't know much about this. So you already defeated yourself. You already lost it before you even started. That you're like the guy that goes and scratch a lottery ticket on the hope of winning. When 75% of the tickets are no winners, you don't stand a chance. You can get a prize, but if you're going to be on that 25%, it'd be a prize, but you're not going to be the jackpot. You see? So you give me the $20 you're going to spend on that lottery ticket. Tomorrow morning, I see you, I give you 20, you make $20 because I save you from blowing it away. But people don't listen. You're going to make money in a casino? Buy a stock in the casino. Don't play the casino. Those palaces are not there because they lose money. Those palaces are financed with the loser's money. And the stock market is the same. If you don't know the game, you can get hurt. So as you notice here, the last one is money, number 5. Moneda, any medium or exchange. And I put a little notice here. Money, that is the last requirement. If you don't master the first 4, you're not going to make it. I've seen people that have lost $500,000. They come to me, how am I going to recover this? What I have done? Well, they listen to the broker, and then when they start losing, they don't even stop it. The broker tells them, oh, well, it goes back up. We say, well, that depends. If you're 80 years old and you're going to take 10 years to go back up, I might not be here to recover. Okay. So there are a lot of things about that you should not listen. Never, never. Rule number 1, never lose your principal money. And rule number 2, read rule number 1. That's famous by Warren Buffett. So they tell me, I don't know. I heard some place, but nobody likes to lose money, even so once in a while we do. So money is not important. Knowledge is important. If you don't have the knowledge, you don't have the discipline, you don't have, you don't know how to read a chart, you're not going to make it. You're already dead on water before you even started. If you don't like this, if you're only doing it for the money, you don't want to make it. You have to love this. This is why you have to be obsessed. So money is the last thing. I started with $500, and people start with $40,000 or $50,000 and they lose it within 90 days, right? So money is no deal. They're doing something else wrong because they had the money, but they didn't have the other part. So with that, let's move to the next slide. Here is a EKG. This is where our lesson begins. This is where our class begins, and this is where your future begins. Lesson 1, let's talk about charts. This is a chart. Somebody took a reading of somebody's heart, but maybe the guy that took the reading and connected the wire, he don't know how to read that. It takes a special person. Somebody got training in medicine, understand how the electricity in our body work with the heart in order to get this signal and tell us what's wrong with our heart. I've been taking many of those because at one time I suffered a stroke. So I see that. I see those lines going back and forth, but I had no idea what is coming out of the paper. And then I had to wait till the doctor comes in and tell me, say, well, you come back next week because we had to send it to the pathologist to read it. And then we get a written opinion from him. So not all of them can read this stuff. Well, we don't either, right? But the same thing must happen with the market. We want to read the chart, but know about somebody's heart condition because we're not doctors. We are stock buyers and sellers. We are traders. So this is the chart that interests to us. This is the chart that we're interested in. We got to learn that this is what this means. What are those lines and waves and bars up and down mean? What are this day? Oh, I know this is October the 5th here. That's November 9. Oh, okay. But that's all, right? That's just like the B5 and B6 on the previous chart. Well, okay. So this is what is called candlestick. This is a candlestick chart. There are many of them with different names on it. There are line chart, bar charts, all kind of different things. But you need to read them. You need to learn how to read this, what it means, what you expect, you know, what it means when you have a gap like this that goes from here to here. It's what's the indication of that? They got names also. They call these spinning tops. They call these hammers. They call the other one hanging man, you know, and stuff like this. A little hanging man here, green, you know, and stuff like that. So we're going to get to all those things. So bear with me. And all we want to know right here is this part, all these little bars that goes up and down. They happen to be a daily chart, okay? Now, we're going to roll up to the next one, the next slide. And this is some of your tools. You see, beside reading the chart for the stock that you're buying, there are other tools like the Dow Jones Industrial, S&P 500, which signify S&P 500 is measure the price change of the top 500 corporations in the United States. Then you get the NASDAQ, you get the Russell 2000. They measure the price change on 2000 company. Wilshire 5000 is the same way. This is the 10-year interest for treasury notes. The federal government borrow money every Tuesday. And this is what you're going to know about how the government and the Federal Reserve work. And this particular chart, you need to know about it and how it behaves, because it can tell you a lot of what happened on the economy. It can tell you a lot about how the market going to behave. As a matter of fact, on 2008, on March of 2008, I predicted that a crash was coming, but many people ignore me. The last class that we had, the students used to come to my class, local guys, they work during the day. So I told them, you come to my home and we do the class at home. And we don't do that anymore. But I used to do that. And I told them back in December, there's something wrong with the market and something is coming and we're going to have a nasty fall. And we did in March, you know, so we can see ahead of time. A lot of that had to do with experience and the years that I've been doing that. And this is what I'm kind of expect this. You get the feeling that's just like when you do a job for a long period of time, you get to know about what works and what don't work, things like that. So we're going to go through these different charts and show you and teach you what you use this as a tool. No different than a mechanic when they use a wrench, or when he use a tool to test your engine on your car. We can use these tools. This is part of the tools. As you notice, they are not a stock for buying or selling. This is a gold spider. It's a ETF. Kind of tell you about things like this is the U.S. oil fund. You can buy that is a mutual fund and so on, but it also makes you the price change on oil, change the price on this, and you can tell when the price is going to go up or going to go down. But that comes further down. Right now, we want to learn how to read it first. If you cannot read it, this stuff over here make any sense. It don't matter. So with that, we're going to move up into this one here, candlesticks and bar chart. On the left, we have a bar chart. This bar chart start with the opening side that is right here. This is the opening. This is the low of the day at the bottom side. At the very top is the high, and right here the close price. So it measures the price during the day. What was the high? What was the low? At what price it opened? At what price it closed? On the other side, we got something similar, but this comes from Japan. It's called Japanese candlestick, and it has almost the same thing. The high price of the days is here. It's a little weak. That's what they call a candlestick. The low is down over here with the L. The opening is right here. And by the end of the day at 3 o'clock, 4 o'clock New York time, when it closed at this price. Inside of this type of candlestick, this chart, we use candlestick, it tells you more than this. This is always black, open and close. It has just similar thing in open and close or vice versa. However, some of them are red, some of them are hollow, some of them are black, and that's a reason for all those things. So it tells you more. It tells you like it opened, you see that it opened, but it opened a little bit higher than the day before. Or it opened lower than the day before, but it climbed up and overcome, and it's higher than the day before. So then you see that it's green, but it might be hollow. So it all depends who designing the chart. So all those things are part of the knowledge, just like reading the EKG. Over here we had now how all these things started. Back in the 1852, there were Japanese rice trader, and one of them became very wealthy. He took notes, he took date, he wrote a lot of information, and but this is what he used to determine the price of the rice going up or down, when was the right time to buy, when was the right time to sell. So he became very famous with that and very wealthy. Now, what happened is that back then there was isolation from the countries. Japan back in 1852, probably Japan don't want to know anything about Americans, and Americans don't want to know anything about Japan. And so they created their own deal without knowing that in the United States, there were other people doing the same thing. The stock market is very old, and they were pricing the stock and using what is called a bar chart. So kind of strange that without knowing each other, they was very similar to that, creating something to measure the stock market or prices. So here, how you call now we call them Western bar charts, which is the famous bar chart because it's of the West. The high and the low, it opened at 5, the high was 12, it closed at $10, and the low of the day was $3. But in between, we don't know if the $3 happened early in the morning, it opened here, and then it went down this way, and then we went back up and went back down again. And then by noon, it went to $12. And then by 4 o'clock, New York time, it closed at 10. We have the same thing here now with a candlestick. It's solid black. And on this chart, those that are white, that got a hollow in it, it seems like they're going up, and it's a black, solid black, is that it went down. It's lower, closed down. So over here, we see the same thing. It opened at, the high was 12, it opened at 5, it closed at 10, and the lowest was 3. Other factors and name applied to this thing, but we learn that as we go along, you know. So let's look at the next one. Now we have over here, we went too much here. The memory of the computer get kind of upset up sometimes. So we're going to expand this a little bit here. We're going to make it a little bit bigger so we can see what we're doing here. The reason I do this so you can observe how they get done. Okay, so we're going to take this one. This is a daily chart. Okay, I mean it's one day. There's 2 days in here, Thursday and Friday, and this is October the 15th, 2020, and this is Friday last week. Today is Monday, so this was Friday, and this is October the 16th, 2020. This is Facebook. But this is, you notice that this candle here and this one look identical. They're white and red, different shapes and different prices, right? However, it's only one thing here we're going to show you. This is by every 15 minutes. You see it right here, Facebook, every 15 minutes. So when the market opened on the 16th, this was the first 15 minutes of trade at 8:30, 9:30 New York time. This is the 10 o'clock. You know, we're coming through here every 15 minutes. We're taking a sample of the price until at the end of the day. So we got many charts, but now it's broke down. Remember that on the other chart, on the daily chart, if you see this, you're going to see the whole bar there, but you didn't know what happened inside of that. So let's move this a little bit here and concentrate on Friday the 16th, okay? The reason we're going to do that, because we'll be able to see, you see, this is 16 October. So October 16 is this bar right here. This is October 15, 14, 13, 12, right? And this is October the 11th, right? So 12, no, this is going to be October 12. The 12 was a Monday, and then you got, so this was Friday, so a few days back that. So 12, I think the 10 or something like that it would be. You see, so look at the whole chart here. And when we look at it, from here, 9 o'clock in the morning, 9:30 when the market opened in New York, you see, on the first 5 minutes, because it says 5 minute chart, you got that. You don't see that here. This is the whole day. This is October 16, Saturday 17, Sunday 18, and Monday the 19th. So this is whole day Friday. This is a daily chart. This is a 5 minute chart for one single day, Friday the 16th. So you notice over here, they go from 11 o'clock to 12 o'clock, 1 o'clock, 2 o'clock, 3 o'clock, 4 o'clock. Market end right here. And this is Monday, which is the same thing here, this line here, 19, 19. So what transcribed over here on the right on 16th of October is all this in here. And people can make money during the day doing that. People could have gone in here and go about $270, and it reached about 271, 272, someplace in here, you know, and at this time, and then you get out, He made $2. He got 1,000 shares. He made $2,000 in a matter of 45 minutes, and he's gone for the day. This is what they call him day trader. If he bought an option, the same thing, an option will go up in value about 50% of what the price increase, so he can make 1,000. It depends how many contracts. We're going to talk about option, how option work, and why a lot of people love options. They love it because they can make a lot of money, right? But what they don't realize also is that that is risky. Options lose value at the time, but we work on that later. What we're doing here is understanding that even so this chart is the same, it looks the same, this is measured by day and this measured by every 5 minutes. You can arrange your chart services to have it made every minute. You can have it every 30 minutes to take a sample of what the market is doing, and each one of them have a use for. Okay, so knowing that, we're going to move now to this chart, and we understand now that this is one day, the other one is by every 15 minutes, but they're all the kind of chart. We are here, we got what they call line chart. It's the same stock now. It's the same Facebook, October, going down the line and so on. But here what happened, right? This is line chart. So now all we know, for example, if we look at one here and one in here, is that the price went up so much on this day. So we got a line from the previous close to the close. So you only going to measure from yesterday close to today's close. So on that particular day, there was October 6, 7, October 7, close over here. And when it opened on October 8th, we don't know nothing until the end of the day. That's when this plotted. So we know that went from here to here. We don't have no way to know where it opened, where it closed. We don't know if it was higher than this. We don't know if it was lower than that. We don't know that. A line chart is a closed date deal. So on the close, that's what you get from the previous day where the line end up. Normally you see this with mutual funds because they had to settle all the account. After the hours, you finally see if your mutual fund went up or it went down, and if you short, that's what the line that you will see. So this is not the best chart for a day trader, but it has its own application. The application is because mutual fund might have 2,000 companies, they go up and down. That don't mean that because they went up and down, all of them might be positive by the end of the day. And what they do is at the market close, they take from the previous day and draw a line to the new price, whether it's up and down. Then over here, we got the bar charts that we saw before, and it tell you the greens, it means that the price went up from when it opened today, but it didn't work hard before, and yesterday it opened over here and closed down here, and it bounced them down, and this create patterns. You see these patterns over here, they mean something. This here, that you see here, how it goes like that, this is exactly at this here. It's the same shape. It goes up a little bit, zigzag, and so on. But this is just to tell you the different type of chart. There are many more that I'm going to explain here now. They got the candlestick that we saw. We also have the bar lines. You have bar lines with the thick one and a thin one. You have the thick ones over here. You got solid lines, which are this one. You got the Heikin Ashik. And the Heikin Ashik is used a lot by day trader. It has a special formula, so you don't want to look like nothing like this altogether, But that's for another story and many more. So with that, we're going to see. We move to the next slide. We're going to have to reduce it first, bring it back to 0, but before it let us go back to the size. Now that we see that, now we can move to the next one. So this thing get upset. The computer get upset every time we do this, you know. So let's see if we can get it to move. Okay, we saw that part, and this is the one that we're talking about now, right? So today, when we look at this, we look in here and we see that this is actually a video. This is the guy at the post, right? This is the head honcho over here. This is the boss, and he's the market maker. He determined the price that he's going to pay for. He determined the price that he's going to sell it for, and he's going to buy. This is his operator. He represents many companies. Let's say, for example, he got 55 different companies that he represents. So one of them is Bank of America. So Bank of America, any order that come in from Bank of America on this particular exchange in the American Stock Exchange, you got to go through him. They cannot go to another post. They call it post because back in the 1800s, where they was selling a stock, they used to trade on the street. There was no building. There was no computer. People sitting on a bench by the telephone pole or the light post, and they say, hey, you want to buy a stock for this? You want to buy a stock for that? And there was all kind of crooked deals going around. That don't mean that they're not going today, but it's more regulated than before. Before it's a free-for-all. You might buy something, you never see the guy again. But the word always stick. The name of the post is stick. And he's the man at the post. And he get a bank that back him up with the money. He might get $500 million to buy and sell stock. And at the end of the year, the $500 million might have turned that he got $900 million. So the bank renews his contract with him, something like that, or the style. This is an example. So don't make it engraved on a stone or anything like that. And then he get a percentage of the money that he make, and he might make $1 or $2 million a year, and he paid this guy $200,000-$300,000 in bonus. Also, the kids, these young kids, are relative or children for this guy working over here summertime, and the American Stock Exchange, and they bring the kid to learn at the office what their dad and pop and mom do. So this is how it goes. So we're going to give you how when you or I make a trade or order, how we get to the exchange, and you're going to see how crazy it get, because there are people from all over the world, all over the country put in order, and they come to him, and there are different posts like that. So let's take a look at this right quick.
Yeah, the last half hour on the trading floor is really busy. It's really sometimes you got to really concentrate, especially when the market starts to make a decent move like it is right now. There's nothing really out there that shows why it should have sold off. 30% of what it was up on the day, but it's taking a good hit here.
4,900 shares and a half ATS.
So here you go, 30% on the market drop. So everybody running like crazy, right? But us at home, when we look at the market on TV, we don't see none of that picture. We don't know what's happening. He says, so there's some more coming up. This is 2 minutes. And then what's going to happen is that when it's 1 minute to trade, the bell going to ring. And it let them know that at 4 o'clock, you stop whatever you are doing. You cannot sell no more. They're going to bring us to something else later on this video, on this class.
Something caused it to sell off here in the last few minutes.
After 24 and 51 sold. 29 more trades at 51. 5,000 trades at 50. You bought 2,500 shares.
Sounds like HOM's picking up a lot more.
I'm out.
You're getting busy now.
No. What's he doing? He's going. You bought 4,800 shares and a half GK. You bought 4,000 shares and a half ATS.
You leave 15,000?
15,000. All right, listen, I'm going after you. Listen, you bought 4,400 shares and a half book.
He's almost done. He leaves nothing.
600,000, 57 sold. 1,000 trades at 56. 54, 5 5,000.
90 bit away, buddy. 90 bit away.
Okay, right here, oh, we probably missed a little bit of it. Let's see if I can get it back here. The guy that's standing in front of him, this is the guy that comes in to place an order with them. You're gonna say, I need to buy this, or I need to buy that, or how many shares of this, and the price. Here you present the paper. He take his word for, and that's it, and that stuff gets settled next day. It takes about 4 days before that order gets settled. But if you're doing it over here, like I do, immediately I get it on my computer that say you bought it, but the money don't come out of my account, or when I sell it, don't come back into my account about 4 days later, because this is just by word. They take the word, hey, I want 500 shares of this. Yeah, I sold X amount, and that's it. So the paperwork to do all the transfer take about 4 days. They're trying right now to narrow down a little bit to be much closer, like options are different. They trade on the Chicago Board Exchange and stuff like that, and they set up overnight. So you buy an option, tomorrow the money comes out of your account. If you sell an option, next day the money is on your account, and all you have to wait for the time to expire or whatever you're selling it and get the money, or you can buy it back if you don't like what's going on. So let's see what happened here now.
54 for 3,000 shares, 2,059.
The most challenging thing is having to make split-second decisions. You can't really think that fast, even though you believe you can. You can't. You're going on instinct. You're going on reaction. And that's the toughest part of the job, is having to stay focused through that.
2,057. Yeah, offers a light after that.
It's been simple.
You see the clock is at 3:59, right? You got 1 minute to close, and all the orders that are stuck behind it, once the 4 o'clock and the bell ring, guess what happened? They stay there overnight. This is something that I want you to know, to understand why we're going to go back to the chart to show you what really happened, and then the price collapse. Okay, so you're going to get an education here that you don't get it nowhere else. I know how the system works. After 48 years, I can tell by looking at that chart exactly what happened. I know how to read that chart, and I'm going to show you how to read them too, so you don't fall in the pitfall that many non-educated ones do. So here we go, and the last few minutes.
Okay. 2,000 trades at 57. ATS 61 to 2,002 taken. 2,000 trades at 52. That's 65. 5,065. 1 5. 5,000. 1 5. 5,000.
What's the bell?
No, 63 for 4,014. 4,000 trade 64. Let's keep selling the bell. 5 more trade 64.
Not enough to get it there. 5,000 shares, maybe.
6,000 trades at 63. 2 5. 5 up.
That's close them up. Amazing, a lot of stress.
See that? Market close. So how about if there are 3 million shares pending that coming in from buyers or sellers? What's going to happen to those? Market's closed. They cannot trade. So the bell start ringing, 10 seconds, it's over. When went through, went it down. They are market after hours, right? But that's a different ball game. They usually after hour market, it lasts about to 8 o'clock at night in the United States. Those orders don't go through there. You have to initiate the order yourself again on the after hour market. Here what happened. Any good company, broker, when you do that, they tell you up front on the screen that they might fill or not fill that order. It might partially fill, half of it might fill, quarter of it might fill, and then next day you have to buy the rest of it when the market opens. So it's a very limited market. You don't know is it going to be bought or sold because the price, there are not too many people trading. About 10 o'clock at night or 9 o'clock at night, then in the other part of the world, when we barely going to bed, then in Australia or Sydney, Australia, somewhere around time of there, the markets start opening over there. So you have a platform that lets you do market on different parts of the world. You can buy and sell almost 24 hours a day. But I recommend to you not to do it because there are various marginal markets. They're not as big. Nothing is bigger than the US market. This is where the money is. Anything else over there is something else. So gradually you get the Asian market to open, European market open, then Germany open, and finally the England market open, and you start seeing this at 3 o'clock in the morning. If you go to CNBC, you see the future and the price, and then a lot of orders coming to United States that the companies that are listed in the New York Exchange, and they say, oh, market should be open at 200 points up this morning. Yeah, but there's a bunch of orders coming in from some other places that they had to fill here in the United States. So let's see what happened here, and then we'll go over what I'm telling you about opening in the market.
I can't tell you how many times I've had what I thought were chest pains and numbness in the arm and sweaty forehead and sweaty palms and dizziness. It's happened at least a half a dozen times. It's the most exciting job you could ever have. If you don't love this place, don't work here. You have to love it. You have to be passionate about it. You have to really care about it. It's a unique person that's able to sustain a career now.
There you go. Okay, so we move to the next one. We're going to move to the next project. That's me on a cruise ship with the captain. But before we do that, we're going to go over here right quick, and I'm going to show you this part here. You notice on the daily candlestick, we're going to have to enlarge it a little bit. So let's move it around. Candlestick, and here we are, right? This is by the minute, remember? Candlestick by the minute. This is one day, Friday. So a day before, when the market closed, like him over there, like you saw in the video, there are a lot of millions of orders stuck right in here that they had not been filled. And then on Friday morning, when the market opened, boom, all these orders start filling up. You can see the volume down here. A lot of people buying way up there. But that don't mean that people are buying right now. That means that a lot of these orders, besides what they're buying right now, are also piled up together with the rest of them that was left behind from yesterday, and some of them that coming from Europe that they only can be traded in the United States. How's that? People don't know that. This is where education comes in. This is what those guys lose 90% of their money. They see this, they say, oh, man, look, it's going up. And now they go and buy. But they see it going up, it never going to end, and they buy. They buy here on the red one. And you see what this later candlestick did? It went higher at the beginning. At one time, this candlestick was green. It went all the way up to here. And then the reason that it's red is because it closed below the close for the other previous 15 minutes. Remember, it's a 15-minute deal. So right here on this 15 minutes of trade, it went even higher, but it didn't hold. How come it didn't hold? Because it was more sellers than buyers. And when there are more sellers than buyers, the sellers push the price down. There's not enough buyers. So the market maker, the guy that you saw there, he start lowering the price on the stock in order to get it sold. He don't want to get stuck with it, right? Somebody else's problem. The guy that's selling said, well, dude, you're selling at the market. This is the best price I could get you. And it was less than whatever he got here. So there are guys that understand this, and they see this and they jump into it. They're going to jump in for $2 or $3. They go in here, boom, 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 boom. Went up, $3 up, 1,000 shares, make $3,000 and they're gone. They sell it. So now the guy that made the money here on the top of it starts selling, and they drive the price back down to where we started and below. And here it is 11 o'clock, and we can never climb up there. We cannot go higher. There's not enough buyers. If we look at the volume, look how the volume is too low. This volume is not big enough to push the price up. That is the truth of the action. And guess what happened? Nobody wants to get stuck with this stock and this stuff in here on Friday afternoon. So guess what? Look at the volume again. They start selling one more time. And then there's some guy that thinks that's a bargain. Oh man, we're going to buy. So it end up indecisive, but it was a heavy volume. So they include the buyers and the seller in the total volume. We don't know how many of these are buying, how much of them are selling. The only thing we know that there was more seller than buyer because the price is down. That do we know for sure. But who they are, we don't know that. The other things about this that is not part of this lesson here that you're going to learn about it. But just to give you a taste of how to read a chart. This is the whole idea. You need to know how to read the chart because every chart tells you the story. More likely when you have seen this before, oh, look, it's going up. Wow, that company is doing good. You don't have nothing to do with that. It has to do with how many, when the market opened at 9:30 in the morning, how many orders were from there the day before, how many orders are coming into the market, that they have to be matched, and all that will drive the price up because there's a heavy volume of buyers. You see? Now, when they're short, there might be people selling a stock that they don't even own. That's short selling. That's another class on its own. That don't have nothing to do with reading the chart. You can tell when you read the charts is a bunch of people selling short or what, but the market counted the same. So this is what I wanted to show you here, right? So you understand what's really happening on the market. It's not like you think it was, and it never would be like we think. The markets are full of surprises. You have the situation that the market by themselves, they actually are a situation where it's a matter of emotions. You got emotions with you. You got all the stuff with it that have a lot to do with it, that it changed. So some people think they're going to go up and other people think they're going to go down, right? So that's part of it. The other part that we're going to read about it is this one. This is another video, and it's a prerequisite of this class that you view this video, because this video is about how the Federal Reserve Bank works. The Federal Reserve Bank is not part of the United States. It might sound like, because it's a Federal Reserve Bank, it don't have nothing to do with the United States. The government of the United States back in 1932 transferred the responsibility of the control of the money to a private corporation. Federal Reserve Bank has shareholders, just like you can buy share for Facebook, you can buy share for AT&T. They are shareholders on the Federal Reserve Bank. They are very secret about that. The bank holders are normally probably the same banks that they operate. Recently, when we have this pandemic and the government starts shutting down, guess where the money came from? From the private corporation. It's a windfall for them because they charge the US government 6% interest for that money on every loan they make to the US government. The funny thing about it is that they don't have the money. They just create it out of thin air. You and I cannot do that. Huh? How about that? If you write a check to somebody and you don't have fund at the bank, they can come and arrest you for fraud, depending on the size of the deal. Or they're going to press charges on you and take you to court to make you pay for that check. But the Federal Reserve don't have to do that. The Federal Reserve write a check that it turns into money, just like magic, and then everything works. Here, people getting $1,200 for the pandemic. Here, businesses getting bailout, the airline getting bailout, everybody getting bailout with that money. But sooner or later, right, we have to pay that back. However, the Federal Reserve, the money that the country owes, that they say, well, the country go broke, countries don't go broke. Not such thing. Mexico has gone through the same thing. Argentina has gone through the same thing. None of them go broke. They're still here today. New York City in 1972 went broke. They're still here today, better than ever. Government bailed them out, you see? But if you go broke, nobody bails you out. You lose everything you have. So it's interesting for you to know how the system works before you even buy a stock. So I'm asking you, I'm begging you that you have to see this video. And if you have any question, there's an email there for you to write me, floresville2018@yahoo.com. We're going to upload this video there so you can see how the government works, how the money turns around. The money that IRS collect on your taxes, it don't go to pay the debt. It goes to pay the interest. That's all it does. It pays the interest on the money that the government owns to the Federal Reserve Bank. The Federal Reserve Bank is the same thing that what they call Bank of Mexico. Same thing. In England, they call it the Bank of England. And they just private corporation that was created by an ingenious guy related to the Pope back in many thousands or hundreds of years ago, and the Rothschild family. And since then, all the countries have some kind of Federal Reserve Bank, one way or another, but the guys behind it are the same guy that manipulate everybody's life. You're not poor because you were born poor. We all were born the same. We have 24 hours. That's what they mean when they say all men are created equal. It don't have nothing to do with color. It had to do with time. We all have 24 hours. And what you do with your 24 hours, that's exactly what you're going to get. I didn't get here because I was smarter than somebody else. I got here because I used my time different than other people did. When other people was washing dishes, I went to school at night. I wanted to learn about the stock. I read books, I read this, so I can get out of washing dishes for 35 cents an hour. And gradually, I stepped out of there. You can do the same. It don't have nothing to do with being smart. It had to do with common sense. You got 24 hours just like me. You want to spend it in a bar drinking? Go right ahead. You're going to keep on working on what you're doing now, right? And every evening you're going to get drunk. When you get to be 60 and you need to retire or you cannot work, that's when you're going to see how different the whole thing is. So this is a video that you need to see. I'm going to ask you for some questions and we can start a little piece of it over here right quick. But the video run probably about 22 minutes. So it's not a killer in any way, but just so you'll be aware of how it works on it. So we're going to upload it to YouTube on the library channel and the playlist, and you'll be able to see it there. You have any questions?
They say that money doesn't grow on trees, but the truth is that the modern banking system creates currency far faster than trees can grow. Most people don't have a clue how currency is created. Economists and bankers make it sound so complex that people think they can't understand it. But I'm going to strip our monetary system down to its essence so that you can see the scam behind the curtain and just how it affects you. Every modern society creates currency in pretty much the same way. But since the US dollar is the majority of the world's currency, I'm going to use the United States as our example. It all starts when some politician says, vote for me and I'll make sure the government provides you more free stuff than my opponent will. But there's no such thing as a free lunch. So to provide that supposedly free stuff, the politicians vote for the country to spend more than its income. This is called deficit spending. To pay for that deficit spending, the Treasury borrows currency by issuing a bond. So what's a bond? If you think about it, a bond is really nothing but a glorified IOU. It's a pretty piece of paper with numbers printed on it that says, look.
I guess now you can understand why I want you to follow the interest on the treasury bond, because it's related to the stock market. It tells you something about what the government is doing and how it can affect the markets. This is more than just reading chart. It's on the chart, but it also affects your life and the way you eat and the way that your family will live tomorrow.
Loan me $1 trillion today, and I promise over a 10-year period, I'm going to pay you back that $1 trillion plus interest. But what you need to understand is that treasury bonds are our national debt. These glorified IOUs are to be paid back by you and I and our descendants through future taxation. Therefore, when the government issues a bond, it steals prosperity out of the future so that it can spend it today. The Treasury then holds a bond auction, and the world's largest banks show up and compete to buy part of our national debt and make a profit on it by earning interest. You'll notice that as we move through this process, the big banks are there, taking a cut every step of the way. This isn't by chance, as you'll see shortly. Then, through a shell game called open market operations, the banks get to sell some of those bonds to the Federal Reserve at a profit. To pay for the bonds, the Federal Reserve opens up its big old checkbook and writes bad, bogus, counterfeit checks that should bounce because they're drawn on an account that always has a zero balance. There isn't one penny in there. To quote from the Boston Federal Reserve.
You see what he said? When you or I write a check, there must be sufficient fund in our account to cover the check. But when the Federal Reserve writes a check, there is no bank deposit on which the check is drawn. When the Federal Reserve writes a check, it's creating money. Put it simple, is simply the Boston Federal Reserve Bank posted that in a report. Now you go ahead and try to write a check and see what happened. But the Federal Reserve don't need to have anything back up. You just create money. How does it create money? You take, for example, right now, on the city where I live, you know, the congressman brought in $2 million for a project. But the city, the project cost $10 million, and the city go to a federal agency, where it was Department of Agriculture or department from this, and they borrow the money, the other $8 million from them. This is why they're given $2 million. They put the hook on them, and now here is $8 more million. So the city had to borrow. It's going to be paid in the 40 years through the uses of the services that they provide. So it don't affect the property taxpayer at all. It's paid by the user. However, remember, they're going to be interest charged. So the Federal Reserve ready to put out some bonds on the name of this city or whatever to finance this project. So the money is not created in Washington, it's created locally. When you buy a car in the city that you live and it's financed, that's exactly what you're doing. You're creating money by borrowing because you want to pay back more than what you got. So where the other money come from? From interest. It's just simple as that. You need to understand this in order to get ahead. So
when you or I write a check, there must be sufficient funds in our account to cover that check. But when the Federal Reserve writes a check, there is no bank deposit on which that check is drawn. When the Federal Reserve writes a check, it is creating money. The Fed then hands those checks to the banks, and at this point, currency springs into existence. The banks then take that currency and buy more bonds at the next Treasury auction. But what is a check? A check is also an IOU. When you write a check, you're making a note that says, here's my IOU for cash. All you have to do is go to the bank and pick it up. Now, it's very, very important that you understand this process because we're going to come back later and show you the devastating effect this has on you. The Treasury issues IOUs, bonds. The banks then buy those IOUs with currency. The Federal Reserve then writes IOUs, checks, and hands them to the banks in exchange for the Treasury's IOUs, the bonds, and currency is created. So what's really happening is the Federal Reserve and the Treasury are just swapping IOUs, using the banks as middlemen, and abracadabra, presto, currency magically springs into existence. This process repeats and repeats over and over again, enriching the banks and indebting the public by raising the national debt. The end result is that there's a buildup of bonds at the Federal Reserve and currency at the Treasury. This process is also where all paper currency comes from. The Federal Reserve and the government.
So there you have it. We're going to get from here to the end of the lesson, so this has covered plenty of it. And we're going to move from here now to just say, make sure that when this loads up on YouTube, you complete this video. And if you have to repeat the lesson, go back over it. If you have any questions, let me know. And this is lesson 1, part 1 of the library seminar that it should have been back in March of 2020. We do it now in November as a request from the library and request to the people that keep on calling the library. So thank you very much for your time. And I hope that I have been clear as possible. Remember, we're not here to make things look pretty. We're here to educate people. We're here to help people understand much better and be able to buy and do investment in the stock. So with that, thank you once again. And thank you for the city and local library of the county for allowing me the opportunity. I'll be talking to them very soon, I think this week. So we can make arrangements for putting other videos on the library channel also. It all depends the kind of format that they want. But meanwhile, you got this one, and it's going to be the same material anyway. It might be in an interview format, or it might be just exactly like this. It all depends what they decide to do. I do whatever I want on my side. They do whatever they want on the other side. And as long as you get the information, that's actually what really counts. So have a good day, and hopefully this start you on a new career about making money on the stock market, and I'll be here standing by your side to help you through. Thank you very kindly for your time. Adios.